Matesh focuses on investing only in mutual funds with a 10 rupees NAV during new fund offers. Whenever a fund house launches a new fund, Matesh is ready with his wallet. Investment advisors label such an approach as flawed and completely wrong. Then, how did Matesh's unconventional path contribute to his wealth multiplication? His investing success defied traditional advice. We first look at the limitation of this approach and then see why and how it worked for Matesh. There are 5 limitations of this approach. First, the rupees 10 NAV doesn't indicate that the fund is cheaper. It serves as a measuring unit. Whether a fund has a NAV of rupees 10 or rupees 100 NAV, they are technically priced the same on a given date as they both invest in the market at the current price. The rupees 10 or rupees 100 NAV are just scales. If the market moves by 10%, the rupees 10 NAV becomes rupees 11 and the one with 100 rupees NAV becomes 110, providing equivalent gains to investors. Second, new funds known as the NFO lack a track record since they are just starting. Advisors generally favor funds with a proven history of performance as it gives them more data to analyze and evaluate. Since future performance is not certain, it is good to wait and see how the fund managers perform over time before committing your money. Third, as the fund gets old, historical data can be used to assess fund manager skills and fund strategy. NFOs lack this historical performance data, making it challenging to gauge how the fund might behave in different market conditions. Fourth, NFOs might have higher initial expenses compared to existing old funds. These expenses can erode returns and investors may prefer existing older funds with lower expense ratios. Fifth is the risk of failure. Some NFOs may not attract sufficient assets under management and may struggle to survive in the competitive mutual fund industry. Existing funds with a track record may be perceived as a more stable and less likely to face closures. Now, with all these limitations, why on earth would this plan work for Matesh? I will address this in 2 sections. In the second section, I will present the funds names and the exact math on how it worked. The first section, let's call it the rupees 10 NAV sachet plan. The psychology of rupees 10 NAV. Picture this. Matesh loves the psychological game. A 10 rupees NAV makes Matesh feels like he's getting in on the ground floor. It is like being first in the line at a blockbuster movie. That thrill of being an early bird. Action bias in action. Now, here's where it gets interesting. Matesh thrives on action bias. The urge to do something, anything, rather than sit idle. And NFOs represent a fresh opportunity, a new adventure. It's not just about numbers, it's about the thrill of taking action. Mental accounting magic. Matesh is a mental accounting wizard. He sees these NFOs as a separate investment bucket. It's like having a dedicated jar for your movie night fund. It might seem psychological, but hey, if it works, it works. Ignoring the NAV noise, Matesh tunes out to the noise around the NAV. Whether it's rupees 10 or rupees 100, for him it's just a number on the journey. It's not about the scale, it's about the potential for growth. Imagine it like choosing a ride at the amusement parks. Different tracks, same joy. Riding the market waves. The market is like an unpredictable wave, right? Matesh rides it with style. If the market does a little dance and moves up by 10%, his 10 rupees NAV becomes 11 and the one with 100 rupees NAV becomes 110. Different numbers, same dance. Everyone is a winner. Now, if you look at a sample of the oldest funds, for example, the ABSL Flexi Cap Fund, the 10 rupees NAV at the beginning has now become 1,408 rupees over 25 years and the fund has delivered 21% annualized return. A different way to look at things. 10 rupees NAV of HDFC Flexi Cap is today rupees 1,399 over 29 years and has delivered 18.6% annualized return. If you feel these are very old funds biased, look at some of the more recent ones. Let's consider a fund with a very poor performance track record. Shriram Flexi Cap Fund just completed 5 years. Let's say you invested at the NFO when the NAV was rupees 10. Today, the NAV stands at rupees 20 after about 5 years, delivering a 14.5% CAGR. Remember, there is no one best style as I covered the pitfalls earlier. This approach is great for folks who hesitate to make decisions, indecision bias or analysis paralysis. It keeps them riding the growth wave in the stock market without missing it out entirely. Simple, right? And this strategy is what we call heuristics in investing, using mental shortcuts to make better investing decisions. So, Matish's journey is not about numbers, it's about psychology, the thrill and the joy of navigating the market in his own unique style. Will this work for you? Well, that's the exciting part of investing, finding what clicks for each of us. And if you find Matish in the crowd, please share the video with all the Matishes who may benefit from inaction bias. If you like the content of this video, please consider subscribing to this channel, liking this video.